Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go over Twitter and look at information. I'll give you my financial opinions. It's going to be commodity, stock market related. I might throw some crypto in there just because it might be at a point where we are below the mining costs. And we've been talking about the difficulty adjustment and mining costs. And I kind of want to just hit that one last time. I don't think people in crypto understand it. As I reach people and they have these arguments, I don't think they understand a lot of what they're actually in. And I'll just kind of give my opinions. Maybe they're right, maybe they're wrong. I think that they're right. I don't see any holes in the logic, and nobody's actually explained with any vivid detail that I'm actually wrong. So let's dive in here, and we'll take a look at what I'm talking about. This is, again, Finding Value Finance on Twitter. If you want to follow me, it's at finding_finance. So this is Bitcoin, and I'm a big charter. I like technical analysis quite a bit. And I do think there's some validity to the chart pattern. It says the current PA looks like PO3 is playing out. Price broke down below the swing lows supported by the FTX FUD. Bullish bias were changed into bearish with a lot of short position opened at breakdown. Reclaim of lost support would lead to an aggressive expansion. And I agree with this because this pattern I see, even with this sell-off, I see it all the time. And you know what we call this? This is called the slingshot cheetah. This is the slingshot where you basically draw in a low, you do a double bottom with the slingshot cheetah low, where then it flings back the other way. And the reason it's a slingshot cheetah low is because it gets forced down. He calls it manipulation. I don't really care what it's called. You have an accumulation zone. You get pushed down to the bottom where you go sideways here. And people put on shorts because it's broken the support level. All those shorts are going to get squeezed back out of it, which creates more demand on the way up as they have to close their shorts. This is the slingshot cheetah that I see in a lot of charts. Now, I'm not buying any crypto. I'm not doing anything like that. I'm just letting you guys know what the pattern looks like. And if you see it in some of the companies, you can use this pattern and you know what it looks like and you've identified it. So slingshot cheetah is what I think is going on there. It says the Fed is not really moving forward with quantitative tightening. Last week, the balance sheet actually increased by $2 billion. From the peak, total assets have not been trimmed by $300 billion. And there's the Fed's balance sheet. You can see it's got slightly lower. And, you know, just by looking at this, you know, the Fed's balance sheet and looking at these things, I'm going to pull up something on TradingView real quick to go over a couple of charts that I think could be important. There's that slingshot cheetah. And what I'm going to go over is the money supply, the PPI, and stuff like that real quick. So when looking at some of this, like here is the United States Consumer Price Index. You can see this guy going on higher here in the Consumer Price Index. And when we look at all this, this is kind of the big long-term, big picture view. These were the expansion phases of real estate. We had these nice big surges higher in the Consumer Price Index. And we've got another surge here. We can look at the United States housing starts. The housing starts correlates with those surges. This is the expansion phase there and there. This is the expansion phase in this area. That's what caused the CPI to grow at a faster pace. This was the last one. And we were coming up into an expansionary phase. I think the Federal Reserve knew that. And what they did is they pegged those rates quick to the upside to slow this down. And I can kind of explain the setup here of what is potentially coming. So let me jump back in real quick. So when looking back at all of these times where we've gone into these expansionary phases of real estate with a demographic, a larger demographic, which is an age group coming into home buying years, which is a larger population, would come in and it would push more credit into the system, it would pull it into the system and get it in the hands of people. That was the limiting factor in the markets during those timeframes. So if you have a surplus of energy, you have a surplus of commodities, and you can expand into that surplus, the driver or the pacing factor in the economy for inflation was the expansion and contraction of the money supply. That was your variable in that equation. But I think what's coming up in the future is a little bit different. And you've got different variables that are leading to inflation in the system. So the other variable now is we're at the end of a credit cycle, and that money's going to be pumped into the system from increasing interest rates and the debt payments. So that money's going to come in, it's going to be sent to, older individuals, the demographic that's getting older, Social Security, Medicare, Medicaid, all of those benefits, money's getting pumped in for that. And then also, with the interest rates going up, as debt rolls over at higher interest rates, more money needs to be created. And that gets into a feedback loop where money just keeps coming in at greater and greater paces because of either the existing, we'll call it obligations in the system, and also the interest rates going up. And that just feeds on itself over and over and over as debt gets issued, new debt gets issued, and it gets issued at greater and greater quantities. Now, that is an input that we didn't have in the past. So that does exist. Now, we also, I don't think, have the input where we can just expand copious amounts of commodities and energy. If those are constrained, and we measure the inflation through the consumer price index, the consumer price index is a measurement of the costs of goods and services. Those costs of goods and services in a world that is restrained or constrained on commodities and or energy, that constraint in the system is going to be inflationary. So we never had that in the past, I don't think. We had it in the 1970s. We had an energy constraint just located in the United States. Now it's worldwide. So that constraint is going to cause havoc on inflation. And given where we are with our currency and the debt levels, having that constraint could really stress the system. So this was the driver behind me. This was the driver and was basically the only factor before. Now it's a factor, and it can kick off all these problems if you've got constraints in the system. And I think they understand those constraints now. So what I think is going to happen is we've got this producer price index divided by the consumer price index. And we've been in this large downtrend channel. You can see this downtrend line going this way, right? Going down. So that's been turned lower, meaning that we've seen a decline based off of efficiencies in the system, where the producer price index and consumer price index have gone lower. My question is this. This pullback here was basically afforded to us through the Strategic Petroleum Reserve releases and the Freeport LNG terminal going down, and we got this pullback in the producer price index. Now, if this comes back and there are still constraints in the system and we stop releasing the SPR and the Freeport comes back online, we could break out of here and start heading higher. And with the other constraints in metals, like copper, nickel, cobalt, on and on and on and on, it means that our producer price index would continue to move higher until we get those inventories basically replaced. So this could be a very inflationary period. We'll see if it sticks around this level here or if we break to the upside. If we break to the upside, it means that we're in a completely different paradigm. And with the debt in the system, we could have problems with the amount of debt and interest rates in this system. it could really kick off a highly inflationary, I'll say, environment. So that's the PPI, CPI, and this is your M2 money supply divided by your gross domestic product. What this is it's basically, if we do have a problem with debt and we do have a problem with our inputs, which is a constraint in energy or a constraint in commodities in general, they're going to have to hit the M2 money supply on a basis higher. And if you're constrained on your GDP, it means that your GDP will not keep up with your M2 money supply growth. And what that's going to look like is a chart that we have right here. Is we're gonna launch higher out of the base of this long-term basing pattern. We've broken out. We did a retest, and our M2 money supply has been outpacing our GDP ever since 2010. We've been creating money at a faster pace than what our domestic gross domestic product can keep up. We see a collapse here at the top, and it's probably correlated to like June. Yeah, June is when they started releasing the SPR and all that other stuff. This is what we need to see. They're shrinking the M2 money supply. They're doing QT, or at least not pumping the system. They're trying to slow it down, but I don't think they can do that. They're constrained, and they're constrained because if they don't pump the system will collapse. And if it collapses, the system, your currency would go away, and that's where all their power is derived from. So I think they have to keep the pump on. And we could see a slowdown in the markets, though, a recession, a large pullback based off of what I'm seeing in this area here. But I'm remaining long where the constraints are. The constraints are in energy and in commodities, and that's where I'm kind of piling in, is where those constraints are at. So we're going to continue to watch this M2 to GDP. We'll see what this thing does, but I have a feeling that it's going to continue higher. This is more or less this, which is more or less this, which is more or less this. I mean, they're just little pullbacks in a move that continues higher. Coming on back, it says, wow, that's a great sign that the bull market in commodities still has a ways to go. And this is fund flows. So we're looking at the macro setup in markets in 2022. You wouldn't expect ETF flows to look like this. And it says the 2022 year-to-date ETF flows in millions. We've got equities flowing a lot into the markets, commodities hardly anything, and then bonds still having money flows. And a lot of people, I mean, we know commodities are going up, and we really don't have much money flows in it. When this money starts to flow in here, guys, you're going to see an epic bull market in commodities. Epic. And it's going to have to flow there. Why? Because there's going to be nothing else that works. Equities don't work because companies that are equities, like technology companies, regular companies that make things, those companies, all they are just it's a tax shield with a company that flings commodities through it. And if your constraints are all in commodities, the energy side or the metals side or whatever it is, money has to flow from equities into commodities because commodities will have to be valued greater if everyone's fighting for those commodities. And the margins of regular companies will decrease if everyone's fighting and paying more for commodities and their energy. Regular consumers are going to have less money to spend on, we'll call it, normal goods and services, and it will be directed more towards food and energy and other commodities that are needed to sustain life. So I think that's what's coming. The money flows have not moved in great quantities yet, but I do think it will based off the market conditions. Looking at this, it says the U.S. West faces power reliability issues from growing use of renewables. If nothing is done to mitigate the long-term risks by 2025, we anticipate severe risks to the reliability and security of the interconnection of our power. I have threw this out there about the net worth. Meta's taken a pretty big hit in terms of net worth. Obviously, Warren Buffett has not, 104 to 109, slightly higher. 122 down to 43 for Mark Zuckerberg. 2 years ago, 30-year mortgage rate was at 2.8%, and average new home price in the U.S. was $395. Today, the 30-year mortgage rate is 7%, and an average new home price is $518. The result, $25,000 increase in down payment, assuming a 20% down, and a 114% increase in monthly payment from $1,298 to $2,779. That is what a shortage of housing looks like. That is the cycle, guys. It has to kill demand. We don't have the homes to satisfy all of that need. Now, did we move too high too fast with the interest rate to kill too much? And are we gonna find a balance in the market? That's what we're gonna have to find out. Are rates too high? Are they gonna have to come back down and balance the market out? That's what we're gonna have to find out. Here's Bitcoin miners are in pain and selling more than they have in almost 5 years. So again, this is going back, and I know people have said that there's some sort of difficulty adjustment. But when you look at this, we're looking at the BTC production costs, and we are down at below the bottom of the production curve. That's what this purple shaded area is. We're down below the production curve where the miners have to pull back. And you can see that miners are selling their Bitcoins to cover that mining cost difference. I don't know what necessarily is going to happen if this were to stay below the bottom of the production costs or supply costs. But I think the network shuts down if you've got no miners at all. Potentially. I don't know. But it's an interesting thing to watch, and I've been watching it. It says the mining needs of green energy to make one car battery for an electric vehicle. So to make each battery, you need to treat 12 tons of brine for lithium, 15 tons of ore for cobalt, 3 tons of ore for nickel, 12 tons of ore for copper, and move 250 tons of the Earth's crust for just one battery, which has about 12 kilograms of lithium, 30 kilograms of nickel, 22 kilograms of manganese, 15 kilograms of cobalt, 100 kilograms of copper, and 200 kilograms of aluminum, steel, and plastic. So that's what you need to do in order to make one battery. That's a lot of energy that is consumed. So if we go into this new world where everyone's driving electric vehicles, which we don't have the materials for, it's going to be incredibly energy intensive. And that energy intensity is where I think we'll strain the system if we get into an energy crisis. I just don't know how that's going to work. Here's another one. Dropping below 16,000 in Bitcoin mining won't be sustainable anymore. Even with the best and most expensive equipment, means miners need to pay more than they earn. Almost all retail miners capitulated already. Bigger mining companies start to become bankrupt. It's dangerous. And I don't know if this system will completely collapse Bitcoin. I don't know. But it's looking very interesting. And the difficulty adjustment doesn't fix this. What it does is it basically takes all of the high-cost miners away at first. Then it goes to the low-cost miners. But the low-cost miners still use electricity. They still run their computers at 100% when they mine. It still has a sunk cost. So even though it's the easiest it's ever been, it still has costs associated with it. It doesn't mean it's free. So that's what is happening, is we still have these sunk costs, and we're coming down to the lowest cost miners. And we could have a problem if it doesn't move on higher at some point. It says consensus oil production forecasts for U.S. oil shale continue to decline. The latest to capitulate is Rystad. It says production forecast is out, and another sharp revision downward with year-end 24 now 1 million barrels per day lower versus August forecast. Supported by well productivity data, capital discipline, and supply chain constraints, there is a growing consensus around peak shale. And this is the lower 48 in the United States, oil production outlook by forecast by timestamp. So this is what the forecast of shale oil was in 2022. They brought it down in August, was the top one. They brought it down in October. They're bringing it down in November. It continues to move lower and lower. And you can see that we're like slightly above the peak here. Now, we could be at peak for the shale oil in the United States. That is yet to be seen, and it'll be obvious when we look backwards, but we could be peaking. We don't necessarily know yet. And the forecast continued to decline out in the future, and it's in the near future. It says the Fed hasn't even pivoted yet, and 30-year inflation expectations are already flirting with their historical highs. This is the U.S. 30-year break-even rate in percent. So inflation expectations are flirting with their highs. We've got differences of single and double bottom here. So I think, if we look at this, this is the gold spot price in the U.S. dollar. Let me see if we can get it to reload there. There we go. What we usually see is a double bottom. So we get a bottom, a top, and then a bottom. And this is that slingshot pattern. If you were to go back and look at that first one we looked at Bitcoin, this is the same pattern. If you draw a line across here, and what happens is you get, this is an accumulation period, accumulation. We dip down a little bit more out of it, and this is called the slingshot cheetah. The slingshot cheetah is where people go short, and they have to cover quickly because the price reverses on them quickly. And I do think this is a double bottom. We're heading higher. I don't know the exact path of what this could take, but usually in the slingshot cheetah pattern, you dip below the low here, which we did. People get short, and then they get squeezed on the way up. It's a violent move higher all the way to the top of 2080. We may break out, do a retest move, and then break higher again. This is that pattern. It's the double bottom W pattern that we have with the slingshot cheetah engaged. That's one reason why I wanted to share this with everybody. That slingshot is engaged. Here's an interesting chart as well. I like this chart. This is the supply of homes is nothing like last time. This is the annual average months of supply of homes for sale in 03 to 2022. This was the last bubble. The housing crash, if you notice, we had 4.6, 4.3, 4.5 months of inventory, 6.5, 8.9. This is the average months of inventory, 10.4. This is bubble territory up here. This is bubble territory. This is where you get a housing crash. You have too much inventory for the market to absorb. So prices come down, especially if they're homeowners that are underwater that need to sell the house, or a bank acquires it through a foreclosure and they're like, screw it, just get rid of the house. How are we in a housing bubble if we have no inventory? Our inventories are lower today than what they were at the beginning of the bull market of last bull market. This is where it's a very unique situation that is very interesting in these markets. I don't think we've ever seen interest rates go up as fast as they have and still have home prices or home inventory as low as it has. It's a very interesting dynamic. And I don't think a lot of people understand that. I understand that it's an interesting dynamic, and I think that it will balance itself out without crashing. And I think interest rates will eventually head a little bit lower for a period of time, and we'll start to see more homes move. But that's an opinion. I don't think we've seen anything like that. Again, U.S. CO2 emissions are now lower than 1917. The U.S. reduced 1 billion metric tons of CO2 since 2005. How did they do that? Really, what they did is they replaced coal with natural gas. And that's 61%. And then they put wind and solar. I don't think that's the big portion of it. I think this is the big portion of it. And I've been heavily invested in natural gas because I know through family members that work in utilities that they were replacing coal power plants with natural gas. It says, to put it bluntly, we have never seen the market bottom with 60% of the Treasury curve inverted. We've had higher percentages of the inversion of the U.S. yield curve at bottoms. So what Tavi's saying is that we could potentially invert even more. And I think that's likely. I think that we'll invert even more, even though we've broken the uptrend in the short term for our 10-year and 30-year yield. I still think there's more inversion out there. when people realize that there's a shortage of energy and that oil prices are going to go much higher. And remember that PPI to CPI ratio, I think that's going to break to the upside eventually. So I do think that the stresses in the system are in energy and commodities. And I think the yield curve, based off of those constraints in the system, will continue to invert, in my opinion. It's going to take time, though. It says, just in case you got lost, navigation here is to guide the long journey. Got silver. And what we see is, this is the breakout. So this is a basing formation, an accumulation zone. This is your lead in, your W bottom, double bottom pattern. This is your slingshot cheetah that comes to the bottom here. Notice how it's slingshotted down. And then boom, it shot up higher, slingshot cheetah style. We've consolidated back to the breakout zone. This is a gigantic pattern, guys. It's massive. All right, this is a massive pattern. It did it back in the mid-2000s as well, where you had a breakout, you had a return move, and then a break. The breakout, the return move, and now we're going to have a big, long run out of silver. Completely agree with the chart. I'm locked and loaded. I also have a lot of really good plays that are, one, I think will work. They're going to follow the silver markets, and then I've got some crazy small micro cap stocks that I think are pretty good with gigantic fractals. That's how big a fractal's the size of this, and we can kind of estimate how high this will go based off of the size of this fractal, the size of this pattern, so to speak. And if you guys want, I've got that all posted on the finding-value.com, the Platinum membership. We talk about those companies. We've been buying the companies down here at this bottom in a following wedge pattern right at the tip. I talk about a bunch of stuff there. Now, here's also about the housing market. This is the housing chart of the day. The blue bar equals the percent of mortgages that could soon see their interest rates rise in 2023. The percent is so low in the United States that I had to circle it. By and large, U.S. borrowers are blessed with fixed-rate mortgages via Goldman Sachs. So over half the mortgage contracts were reset to higher interest payments in 2023 in Australia and New Zealand. And that I think is a problem. This could be a bubble in Australia and New Zealand and maybe even the UK and Canada because of the interest rates going up and the resets to higher interest payments. US does not have that problem. We are all on 30-year fixed rate mortgages, so I'm on that too. My rate is 2.75%. I saw this coming. I locked in as low as I could, and I'm cool with it. So again, this is an interesting dynamic. We've had interest rates rocket higher, and the U.S. isn't nearly as exposed in terms of risks for interest payments increasing. Not even close compared to some of these other countries. So I just wanted to cover that as well. But again, guys, there's a lot of stuff going on right now. And hopefully I've accurately described kind of the situation that we're in. Again, constraints in commodities, constraints in energy. That is a huge investment opportunity. I also think to de-risk the portfolio with physical metals is a pretty smart thing to do, especially when they're as cheap as they are. We can see a lot of these patterns that are developing, and I'm aware of these patterns, and hopefully you guys are becoming aware by watching the channel. I'm obviously doing training sessions that I've videotaped before on the website. You can watch those if you're a Platinum member. You can watch those training sessions. You can see all the different patterns that we go over. I will be doing another training session soon. I have to figure out to schedule it. And we'll do another training session with technical analysis and other question and answer. This is going to be an open session to ask a lot of questions, and we can really get in there and start looking at charts, looking for patterns, and I can show you guys a bunch of different patterns and go over recognized ones. Now, we've already done that in the past. You can see videos on the website, but this is to further progress your guys' selves in technical chart reading and also becoming better and more comfortable with it and kind of my approach to investing. So obviously, guys, if you like the content, give me a thumbs up. Subscribe to the channel if you haven't already. Subscribe to the website if you'd like, finding-value.com. And we'll catch you guys later. This is Finding Value.